Related party transactions for audit. What do you need to know? Well, first you might want to know what parties are considered related. The auditor searching for related party transactions should obtain an understanding of each party's relationship to the total entity. So, if Company A owns a significant influence in Company B, they are related parties because of that significant influence. Remember the equity method where you can significantly influence the other party? You own 20 to 25% or more of the stock. You can significantly influence them. That makes them a related party to you. They don't have to be a wholly owned subsidiary. Obviously, if they were a wholly owned subsidiary, they would be a related party to you also because you could control what they do. You could control the sales to them, the purchases from them. So if Company A owns 51% of Company B, they are related parties. 51% or more would be a subsidiary relationship. Those first two are pretty obvious. What about this one? Company A owns B, B owns C. All three would be related parties then. Because since B owns C and B is wholly owned by A, then A, B, and C are all related parties. What about this one? Company A has significant influence in C. Company B has significant influence in C also. Remember, for significant influence, you only have to own 20 to 25%. So both A and B both have a significant influence in C. So that means A and C are related, B and C are related, but what about A and B? They're not related. Besides equity method investees and subsidiaries, who else is a related party? Related parties include management, principal owners, principal shareholders, and their immediate family members. All are related to the corporation. They're all related parties to the corporation. So let's start this. Which of the following represents related parties to Company X? A. Company X owns a significant influence but not control in Company Y. Yeah, but the significant influence, they're still related party. We're looking for related parties. So far, A is related, X and Y. But letter D says all of these are related parties to Company X, so why don't we go down to choice B? Company X and the immediate family members of its officers. Yes, they are related parties to Company X. So A and B so far. C, Company X owns Y, Company Y owns Z. They are all related to Company X. Since Y owns Z and Y is wholly owned by X, then X, Y, and Z, they're all related parties. And D would be the right answer. So besides the equity method, it's investees and subsidiaries. Related parties include management, principal stockholders, and their immediate family members. So which of the following is a related party transaction for Corporation A? All right, Corporation A purchases land from a spouse of a board member. Okay, so you have a family member, an immediate family member of a board member. That's a related party transaction. B, corporation purchases goods from Company B, a company that is 10% owned by Corporation A and has a similar name. So it's only 10% owned, so it's not an equity method investor. And it has a similar name, but that doesn't make it related. Because we said for it to be related, you would want to have an equity method relationship or a subsidiary relationship, or maybe management, principal shareholders, and their immediate family members. A company with a similar name or one that's only 10% owned would not meet those requirements. All right, all companies have related parties and often engage in transactions with them. It's not illegal, but it does pose risks for the auditor. So you have your related party transactions that might be in the normal course of business. Here, the auditor is concerned about whether the transaction is accounted for properly and disclosed properly. And then you have your related party transactions that are outside the normal course of business. And here the auditor is concerned about whether the transaction is accounted for properly, disclosed properly, and whether the transaction was properly authorized. And they would look to the board. The auditor would look to the board of director minutes to see if it was authorized properly. Because the auditor's primary concern with related party transactions is whether they're appropriately accounted for and whether they're appropriately disclosed. Because if they're not, you're looking at material misstatement of related party transactions. So if these transactions are within the course of normal operations, the auditor is primarily concerned with whether they're accounted for and disclosed as related party transactions, not the fact that they merely happened, because all companies do engage in related party transactions. Some more than others, but they almost all do. The point is, if one party can influence the other, then free market dealings cannot be assumed. The auditor cannot assume that arm's length transactions are going on if one party can influence the other. Now, this is important. The entity need not include a statement that the related party transactions were consummated on terms equivalent to those that prevail in arm's length transactions. The auditor expects that they're favorable terms, and it's okay, provided it's properly accounted for and disclosed. There's nothing illegal about a company granting a loan to a related party at below market interest rates. One company can absorb the expenses for the other, but it has to be properly disclosed. So the biggest problem for the auditor is that the related party transaction was not properly disclosed, and instead the company tried to get away with showing it as an arm's length transaction. Notice the company does not need to try to describe or include a statement that the related party transaction was consummated on terms equivalent to those that prevail in an arm's length transaction. They don't have to make that case because the auditor probably isn't going to believe it anyway, and if they did make that case, the auditor would need a lot of evidence to back it up. So for the entity being audited, as long as it's properly accounted for and disclosed as a related party transaction, that's enough to satisfy the auditor. So what does it take to properly disclose related party transactions? Well, you need to disclose the nature of the relationship. How are the parties related? Is it a family member? Is it an equity method investor? Who are we doing business with? A description of the transaction. Is it a purchase and sale? Is it services? What type of transaction is it? That needs to be disclosed. The dollar value of the transactions. They need to be disclosed. And the amounts due from or due to the related party at the balance sheet date. How much is owed from them? How much is owed to them at the balance sheet date? And the terms and matter of settlement, if not obvious. So for a reporting entity that has participated in related party transactions that are material, disclosure in GAAP-based financial statements should include which of the following? A says, nature of the relationship and a description of the transactions. Yes. B says, a statement that the related party transactions were consummated on terms equivalent to those that prevail in an arm's length transaction. No. We said that's not required. So the answer is A. The company does not need to try to convince the auditor that these transactions were consummated on the same terms as they would be if the parties were not related. How about this one? For a reporting entity that has participated in related party transactions that are material, disclosure in GAAP-based financial statements should include which of the following? A says a statement as to whether the transaction would have occurred had the two entities not been related. So does the company have to try to convince the auditor that this transaction would have occurred anyway, even if we were not related? No, the entity does not need to disclose that. B, the dollar value of the transactions. Yes. So B is correct. It's almost impossible for the auditor to determine whether this transaction would have occurred had the two entities not been related. So that's just not something that needs to be disclosed. What needs to be disclosed is the nature of the relationship, how they're related, a description of the transaction. Was it a purchase and sale? Was it services? What was the dollar value? And the amounts due from or due to the related party at the balance sheet date, and the terms and matter of settlement if it's not obvious how it's going to be settled.